Hello and welcome to lesson 2 of Accounting 3224, Managerial Accounting. We are going to talk about job order costing in this lesson. The material is covered in chapter 5 of the textbook. The learning objectives for this lesson include how to describe job order costing, to calculate predetermined overhead rates, to describe and account for cost flows in a job order costing system, to calculate applied manufacturing overhead, to close manufacturing overhead, whether over-applied or under-applied, and to prepare a schedule of cost of goods manufactured and an income statement under job order costing. Job order costing, it's a system that's used in situations where the products manufactured are not homogeneous. So if you have different products or jobs or even services provided for produce in a period of time, you would end up using a job order costing system. And the rationale is that because each job is different, the cost records for each distinct job or product need to be maintained. So here's a look at some documents that are used to track costs in a job order costing system. The first document is a bill of materials, which is essentially a record that lists the type and quantity of each major item of materials that's needed to make a product. A materials requisition form, on the other hand, is a detailed source document that specifies the type and quantity of materials that are to be taken from the storeroom and identifies the job to which the cost of those materials are to be charged. Essentially, it helps keep track of how much of various types of materials were used for a given job. Both the bill of materials and the materials requisition form help in keeping track of direct materials cost. Next up, we have the time ticket, which is a source document that's used to record employees' hour-by-hour activities during a day, and it helps keep track of direct labor cost. Finally, we have a job cost sheet, which is a subledger for the work in process inventory account, and it's essentially a form that is prepared for each job in which we record the materials, the labor, and the overhead costs that are charged to that job. Now, here's a look at the documentation process under job order costing. We start with a sales order. So a sales order is prepared as a basis for issuing a production order. Now, what the production order does is it starts work on a job whereby the costs are charged through, and we looked at the source documents in the earlier slide, a materials requisition form, a direct labor time ticket, and predetermined overhead costs. These costs are the production costs for direct materials, direct labor, and manufacturing overhead. These production costs are accumulated on a job order sheet. They are prepared by the accounting department, and that document is called job cost sheet. So the job cost sheet forms the basis of calculating the product costs and unit costs to be used to value ending inventories and to figure out the cost of goods sold for the units sold. The steps involved here, then, there are 4 steps that we must be aware of. In the first step, We want to determine the manufacturing overhead rate. Sometimes the rate is provided to us, sometimes we have to calculate it. We next should calculate the amount of manufacturing overhead applied to various jobs. And sometimes we also have to do some calculations regarding work in process. Step 2 involves preparation of T accounts. There are 7 T accounts that are usually prepared, and we will be talking about these in the following slides. Step 3 is to close any over or under-applied manufacturing overhead. And then step 4 is preparation of a schedule of cost of goods manufactured and income statement. Now, these steps represent the typical steps that will be involved in a first midterm exam problem, a comprehensive problem where you're given information about a manufacturing company that uses job order costing, and you will basically be going through these steps in completing that problem. Now, a typical problem could take you anywhere between 50 minutes to about an hour to complete. These are fairly comprehensive problems that we will be getting towards. Now, you may wonder, why would a company need to use a predetermined manufacturing overhead rate? Using such a predetermined rate helps managers get an estimate of how much a completed job will cost before the end of the accounting period. So it helps in planning. And it also helps companies provide estimates to customers for jobs. So think about uh, a um, a home renovation company. If you were to call in the home renovators and ask them to provide an estimate for how much it would cost to redo your kitchen, if they had no idea about how much the job would cost, and it's not just the cost of materials and labor, there will be other costs that the company also has to recoup. If they do not have a good handle over how much their costs are going to be, their estimates might end up being too high or too low. If the estimates are too high, they might not get your business because you will be getting competitive rates from other renovation companies as well. Now, if they end up pitching a rate that's too low, then likely they will end up losing money on that job. So it is vital for companies that engage in providing uh, goods or services that are customized to have a very clear understanding of how much the job will cost before they actually commit to carrying out that job. Secondly, components of manufacturing overhead, such as heating costs, for example, can cause actual overhead rates to fluctuate. And this could result in different costs being allocated to identical jobs given the differences in the time of the year they were performed. That's not a good idea. You want to have some uniformity of to your costing system. And finally, using predetermined rates helps in simplifying record keeping for the accountants. The second question you might have is, why should a company use an estimated or a predetermined manufacturing overhead? Why not use the actual manufacturing overhead cost? Well, there are a few good answers to that. First of all, manufacturing overhead is an indirect cost that is very difficult to trace to a particular job or product. Secondly, manufacturing overhead consists of many different items. Some examples might be factory rent, factory insurance, depreciation on the factory equipment, utilities costs, factory supervisor salaries. So you can get the idea there. It can because of the fact that MOH consists of many different items, it is very difficult again to try to tease out how much of the actual manufacturing overhead related to a particular job or product. Now, it is helpful that manufacturing overhead tends to stay more or less constant because it does include several fixed costs. But actual production, as you know, can vary due to seasonality. During peak season, the company might be carrying out more jobs. During low season, they might not have as many jobs. So using a predetermined manufacturing overhead rate helps smooth the impact of um, seasonality. Manufacturing costs, overhead costs are often paid at varying frequencies as well. Production tends to be conducted continuously. So once again, using a predetermined overhead rate to charge to various jobs is helpful in smoothing out the costs. So considering the above difficulties, the preferred approach is to use the allocation process, whereby we allocate or charge manufacturing overhead costs to various jobs or products. And this is done by choosing an appropriate allocation base, which is essentially a measure of activity um, to help assign those costs to various cost objects. The allocation bases typically tend to be direct labor hours for a labor-intensive production process and machine hours for a company that uses more machine time than direct labor. A little more on allocation bases. Usually, budgeted direct labor hours is the most commonly used allocation base, and you'll find that most of the exercises and problems in this course use direct labor hours as the allocation base. But other bases may be used as well, such as direct labor cost dollars rather than labor hours, direct materials cost, machine hours, or sometimes there are industry-specific allocation bases, such as for a hospital, it could be the number of beds. For airlines, it could be the number of flight hours. So the bottom line is that you must read the problem, the question very carefully, especially if it's a midterm exam. You should pay attention to the question and identify what is the allocation base being used by the company, because you could end up making mistakes if you're not careful with reading. So here's a look at the steps involved in the problems that we'll be doing. First step, you want to calculate the manufacturing overhead rate, the applied manufacturing overhead, and sometimes do some math for work in process. So first step, calculate the predetermined manufacturing overhead rate if it's not provided. And that calculation is essentially dividing the estimated manufacturing overhead for the coming year. Remember, this calculation is done before the year starts. So the company must prepare a listing of various manufacturing overhead costs, add them up to get the total estimated manufacturing overhead. Those manufacturing overhead dollars are then divided by the budgeted hours. Typically, it's hours, either machine hours or direct labor hours, to get the manufacturing overhead rate per hour. Then, as production is carried out, we calculate the applied manufacturing overhead, and the manufacturing overhead is applied using actual hours. So predetermined rate is calculated using budgeted hours, but the application of manufacturing overhead is done using the predetermined overhead rate, but on actual hours. Okay, this is often an area where people make mistakes. So please pay close attention to this fact. And then sometimes we are required to do some calculations for work in process, either the beginning work in process or the ending, sometimes both. And the calculation usually involves us being provided with the direct materials cost included in the work in process. The direct labor costs are sometimes given, or sometimes we are given the hours and we can do a pretty easy calculation, multiply the hours by the wage rate to get the direct labor cost. And typically where we need to do the math is to calculate the applied manufacturing overhead included in the work in process. Now, the applied manufacturing overhead is basically so if labor hours was the allocation base, the amount of labor hours in the work in process multiplied by the manufacturing overhead rate. To help understand this a little better, let's take a look at in-class example 5-2. So here we're given information about Weaver Company. The requirement is what's the total manufacturing cost assigned to job A200. So if you look at the details in blue, there's direct materials cost, $200. Direct labor cost is $120. So if we were to answer the question, what is the total manufacturing cost? Remember from chapter 2, total manufacturing cost is the cost of direct materials, direct labor, and manufacturing overhead. Now we know that the direct materials cost is $200. We know the direct labor cost is $120. We don't know how much the applied manufacturing overhead cost is to this job A-200. So we must calculate that. We are told that the company's predetermined overhead rate is $18 for each direct labor hour. So the applied manufacturing overhead would be $18 multiplied by the number of direct labor hours. Now, unfortunately, the number of direct labor hours is not given to us. What we are provided with is the total direct labor cost and the fact that the wage rate is $12 an hour. So we can use that information to calculate the number of direct labor hours. Direct labor hours is $120, the total direct labor cost, divided by the wage rate of $12 an hour, which is 10 hours. Once we know that the company had worked 10 direct labor hours, we can then calculate applied manufacturing overhead by multiplying those 10 hours by the $18 an hour of predetermined overhead rate to get $180 for the applied manufacturing overhead, which means our total manufacturing cost is now $200 for direct materials, $120 for direct labor, $180 for the applied manufacturing overhead to get a total of $500. Our answer to part 1, total manufacturing costs assigned to job A-200 is $500. The second part of the question said, if job A-200 consists of 50 units, what is the average cost assigned to each unit included in the job? Okay, if our total manufacturing costs are $500, and that $500 is 50 units worth, then the average cost per unit must be $10. $500 divided by 50 units gives us $10 per unit. Next, we'll take a look at step 2, the T account for cost flows. I mentioned that we usually prepare 7 accounts, 7 T accounts. Now, the 7 T accounts essentially are the 3 inventory types: raw materials, work in process, and finished goods. We also include manufacturing overhead costs. We do a T account for cost of goods sold, for sales, and operating expenses. In these T accounts, we record the flow of costs. So the transactions that we record, mind you, I'll be showing you journal entries. We will not be recording the journal entries in actual practice. We will rather be posting the these journal entries directly into the T account. So the impact on the 7 T accounts that we mentioned is highlighted in red. As we'll go through the journal entries, you'll find as the 70, one of the 70 accounts is involved, I would highlight that in red. So first off, the company would buy raw materials. Usually that is done on credit. So the journal entry there would be debit raw materials inventory and credit accounts payable. Now, we will not bother with the accounts payable side. We are only interested in the impact to our 7 T accounts, one of which is the raw materials inventory account. We will debit the amount of purchase of raw materials to the raw materials inventory T account. Next, the business would issue the direct materials for production. So as materials are issued for production, the raw materials inventory decreases, and the raw materials, because the work begins on them, they get transformed from the raw material stage into work in process. So the journal entry here will be debit work in process inventory and credit raw materials inventory. Notice here, both work in process and raw materials are part of the 70 accounts that we prepare. So notice we credit the raw materials inventory for the cost of direct materials, and we debit work in process for the same dollar value. So it's a flow of cost out of raw materials into work in process. Now, materials may also be consumed in the form of indirect materials. We talked about the difference between direct materials and indirect materials in chapter 2. Indirect materials are treated as manufacturing overhead. So debit manufacturing overhead for the cost of indirect materials and credit raw materials inventory because the raw materials inventory would be depleted. Next, we will incur direct labor costs. Direct labor costs are added to work in process, so debit work in process inventory, credit salaries and wages payable. Some of the labor costs may be considered to be indirect labor costs. Indirect labor is part of manufacturing overhead, so debit manufacturing overhead, credit salaries and wages payable. And finally, the business may incur other manufacturing overhead costs. Now, these other manufacturing overhead costs can relate to many different types. So it could be payment of factory rent, payment of factory insurance, utilities costs, depreciation on factory equipment, et cetera, et cetera. So a lot of accounts might be involved. All of these costs, though, if they are related to the production facility, they're part of manufacturing overhead. So the actual costs being incurred, we debit manufacturing overhead for those actual costs, and the credit will go to various accounts depending on the nature of that manufacturing overhead cost. Keep in mind that the business will be charging manufacturing overhead to various jobs based on a predetermined manufacturing rate. So as manufacturing overhead is charged to jobs, we would debit work in process inventory and credit manufacturing overhead. Once the goods are completed, they are transferred from work in process to finished goods inventory. So you will debit finished goods inventory and credit work in process. Just a little reminder that the actual overhead costs are not charged to jobs. The actual overhead costs do not appear on the job cost sheet, nor do they appear in the work in process account. Only the applied overhead costs, which is based on the predetermined overhead rate, appears on the job cost sheet and in the work in process account. The completed goods are sold by the company, and once these goods are sold, the company will record cost of goods sold. So assuming that the company sells goods on credit, the company will record a debit to accounts receivable and credit sales revenue, and debit cost of goods sold, credit finished goods inventory. Here's a little example, example 5-4, Lancaster Company recorded these transactions for the just completed month. The requirement is to record the above transactions in journal entries. We'll look at each of these transactions. First transaction, $45,000 in raw materials was purchased on account. So purchase of raw materials will require a debit to raw materials inventory because our raw materials inventory will increase. Inventory is an asset, assets are debits. So debit raw materials inventory and credit accounts payable. The second transaction, $125,000 in raw materials was requisitioned for production. Of this amount, $70,000 was for direct materials, and the remainder was for indirect materials. So out of $125,000, $70,000 was for direct materials. So direct materials costs, we will debit work in process inventory. The difference, $55,000, we will debit manufacturing overhead because that relates to indirect materials. And the total amount of $125,000 credit raw materials inventory. The third transaction, total labor wages of $212,000 were incurred. Of this amount, $183,000 was for direct labor, and the remainder was for indirect labor. So the cost of direct labor, we would debit work in process inventory. For the cost of the indirect labor, we will debit manufacturing overhead. And for the total labor wages, we will credit salaries and wages payable. Fourth transaction, additional manufacturing overhead costs of $189,000 were incurred. For this, you will debit manufacturing overhead and credit various accounts. Those various accounts could be accumulated depreciation for the depreciation on factory equipment or building. You'll credit salaries and wages payable for, let's say, the factory supervisor salaries. You will credit accounts payable if it's related to utilities costs that will be, paid at a later date, so on and so forth. Next, we'll take a look at step 3, which is the disposition of over or under applied manufacturing overhead. Now, notice that given the fact that the actual manufacturing overhead costs were debited to the manufacturing overhead account, and the applied manufacturing overhead costs were credited to the manufacturing overhead account, the total of the actual manufacturing overhead, which is the debit side of the manufacturing overhead T account, and the total of the applied manufacturing overhead, which is on the credit side of the manufacturing overhead account, may not be equal. So if they're not, there's two possibilities. Either the actual manufacturing overhead is greater than the applied manufacturing overhead, means we'll have a debit balance in the manufacturing overhead T account. This would imply that the manufacturing overhead cost for the period was under applied, i.e. not applied as much as the actual costs incurred. If that is the case, then we need to close out the under applied manufacturing overhead. Because there is a debit balance in manufacturing overhead, to close it, we will credit manufacturing overhead, and the debit goes to cost of goods sold. Now, the opposite may also be true. We can have the actual manufacturing overhead being less than the applied manufacturing overhead. This will imply a credit balance in the manufacturing overhead account, and we will read this as being manufacturing overhead over applied. In this case, to close out the over applied manufacturing overhead, we will need to debit manufacturing overhead. And this is where the difference is with closing out an under applied manufacturing overhead. Under applied manufacturing overhead is closed against cost of goods sold, end of story. But if manufacturing overhead is over applied, the entry involves crediting 3 accounts. We will credit work in process inventory, finished goods inventory, and cost of goods sold. Now, how that amount is split, we will take a look at in the next slide. So here we will talk about calculation for over applied manufacturing overhead. As we mentioned, over applied manufacturing overhead is allocated to work in process, finished goods, and cost of goods sold. This over applied manufacturing overhead, the allocation is done on the basis of prorating. So we will prorate the dollars amongst the ending work in process, ending finished goods, and for cost of goods sold, we need to adjust it for beginning balances of work in process and finished goods. For cost of goods sold, we will take away beginning work in process and beginning finished goods. After we've determined those balances, we will allocate the over applied manufacturing overhead based on the relative amounts. We will be looking at an example when we do a detailed problem in class later on. But for now, here we have example exercise 5-3. Logan Products calculates its predetermined overhead rate annually on the basis of machine hours. At the beginning of the year, it estimated its total manufacturing overhead will be $348,000, and machines will be run a total of 20,000 hours. We can use the information to calculate the predetermined manufacturing overhead rate. $348,000 divided by 20,000 hours is $17.40 per hour. The actual total machine hours was 19,500 hours. So the applied manufacturing overhead for the year is 19,500, the actual hours, times the predetermined rate of $17.40, or $339,300. The total actual manufacturing overhead for the year was $336,400. So when we compare the applied manufacturing overhead to the actual manufacturing overhead, we can see that the applied manufacturing overhead is greater than the actual manufacturing overhead. So the company over-applied manufacturing overhead during the period by $2,900. That's basically the difference between the applied MOH, 339,300, and the actual MOH, 336. Here's another example. Carrera Corp uses a predetermined overhead rate of $23.10 per direct labor hour. This predetermined rate was based on 12,000 estimated direct labor hours and $277,200 of estimated total manufacturing overhead. If you actually do the math, 277,200 divided by 12,000 does work out to $23.10. So in this case, they gave us the predetermined overhead rate. The company incurred actual total manufacturing overhead costs of $296,000 and 12,600 total direct labor hours during the period. So how much is the manufacturing overhead applied? To get that, we would multiply the actual hours, 12,600, times the predetermined rate of $23.10 to get 291,060. The actual manufacturing overhead is $296,000 given. When we compare the two, we can see that the company has actually under-applied manufacturing overhead by $4,900. The question continues and asks us to prepare the journal entry to dispose of the over or under-applied overhead. So here, because the overhead is under-applied by $4,900, what we do is we will debit cost of goods sold and credit manufacturing overhead by $4,940. Let's take a look at a summary of the overhead concepts. So at the beginning of the period, we calculate the predetermined overhead rate by dividing the total estimated manufacturing overhead by the total estimated units in the allocation base. Remember, the allocation base may be direct labor hours, maybe machine hours, maybe whatever. The predetermined overhead rate is used during the period to calculate the total manufacturing overhead applied. And that is done by multiplying the predetermined overhead rate by the actual total units in the allocation base. So actual labor hours or actual machine hours. At the end of the period, the total manufacturing overhead that was applied is compared to the actual total manufacturing overhead cost. Now, this could result in either under-applied overhead if the actual cost is greater than the manufacturing overhead applied, or over-applied overhead, in which case the actual manufacturing overhead cost was less than the applied manufacturing overhead. So If the manufacturing overhead is over applied, then we will allocate among work in process inventory, finished goods inventory, and cost of goods sold. If, on the other hand, the manufacturing overhead is under applied, then it's simply written off against cost of goods, which is what we saw in the earlier example. Okay, let's revisit the concept of budgeted manufacturing overhead rates. Now, in most examples, we will be using budgeted or estimated amounts of the allocation base. So budgeted direct labor hours or budgeted machine hours. However, if budgets were to change from year to year, the manufacturing overhead rate will also change year to year, and that can create problems. So a suggested solution is to use capacity as the denominator for calculating the manufacturing overhead rate. So capacity would be how much the business is able to. So if we were using machine hours, uh, the how many machine hours the company can run during a given year, or if it were labor, given the number of employees, how many direct labor hours the company could run during the year. Now, this has a result in providing us with a more consistent manufacturing overhead rate. But because companies do not always operate at full capacity, the outcome will be that manufacturing overhead will almost always be underapplied. Now, people that bat for this approach will say that using capacity to calculate manufacturing overhead rate can actually help improve decision making, because then you don't have to worry about the impact of MOH. You will always be considering the manufacturing overhead rate um, consistently. However, companies are not allowed to use this approach for preparing financial statements for external reporting. So IFRS does not allow companies to do this. On a very theoretical basis, though, here's an example. I think you have something similar in your Connect homework set. So I apologize for the longish example here. This company, Elderberry Recording, is a small audio recording studio that handles work for ad agencies, primarily for radio ads. The company handles all aspects of recording, from editing to making a digital master file and so on. The completion in the audio recording industry is obviously, competition's been always tough, but it's been getting even tougher over the last several years. The studio's been losing customers to newer studios that are equipped with more up-to-date equipment and are able to offer more attractive prices and better service maybe. Summary data concerning the last 2 years of operations are given. So 2013 and 2014, you can notice the estimated hours of studio service was 1,000 for the year 2013, which dropped to 750 hours for 2014. The estimated studio overhead costs remained constant at $90,000. Costs tend to be sticky. Actual hours of studio service provided was below what was estimated. So 900 hours in 2013, 600 hours in 2014. The actual studio overhead costs incurred, this is great that the company was able to remain spot on target, $90,000. The capacity of studio service that the company has is 1,800 hours. The company applies studio overhead to recording jobs on the basis of the hours of studio service provided, For example, 30 hours of studio time were required to record, edit, and master a recent music CD for a local band called Fire. All of the studio overhead is fixed, and the actual overhead costs incurred was exactly as estimated at the beginning of each of the years 2013 and 2014. That's a fair bit of data. First requirement. Algebraic recording computes this predetermined overhead rate at the beginning of each year based on the estimated studio overhead and the estimated hours of studio service for the year. How much overhead would have been applied to the Fire job if it had been done in 2013 and 2014? By how much would overhead have been under-applied or over-applied in 2013 and 2014? So first, let's take a look at the 2 years, 2013 and 2014. The predetermined overhead rate for 2013 will have been $90, and that's 90,000, the estimated MOH, divided by 1,000 hours of studio service that was estimated for 2013. For 2014, because the studio actually estimated only 750 hours of will be worked, the predetermined manufacturing overhead rate will have been $120, 90,000 divided by 750. The actual studio hours for the 2 years were 900 for 2013 and 600 for 2014. So the applied overhead in 2013 will have been $90 times 900, 81,000. In 2014, the applied manufacturing overhead will have been $120 multiplied by 600 hours, $72,000. The actual manufacturing overhead for both years, though, was 90,000. So you'll notice the applied manufacturing overhead for both years is actually under-applied because the actual manufacturing overhead for both years was greater than the applied manufacturing overhead. Now, for the Fire job, how much would have been applied for overhead? 30 hours. I recall Fire job had 30 hours. So 30 hours multiplied by $90 an hour. For 2013, the applied cost to the Fire CD will have been $2,700. For 2014, that cost will have been $120 an hour times 30 hours, or $3,600. The second requirement, the president of Algebraic has heard that some companies in the industry have changed to a system of calculating predetermined overhead rate based on capacity, estimated studio overhead for the year, and the hours of studio service that could be provided at capacity. You'd like to know what effect this method will have on the various job costs. So if we calculate the overhead rates based on capacity, the total capacity is 1,800 hours. So in both years, the predetermined overhead rate will have been $50 an hour. So the MOH applied to the Fire CD job in both years will have been $50 an hour times 30 hours, or 1,500. So considerably less than what would have been charged under the existing system. The actual studio hours were 900 and 600 respectively. So the applied manufacturing overhead will actually have worked out $45,000 for 2013, $50 an hour times 900. And in 2014, it will have been $50 an hour times 600 hours, $30,000. The actual manufacturing overhead was $90,000 in both years. So that will have meant under-applied manufacturing overhead to the tune of $45,000 in year 2013 and $60,000 in the year 2014. The third part to this question, how would you interpret these under-applied or over-applied overhead that result from using studio hours at capacity to calculate the predetermined overhead rate? So the way this is interpreted, when we use predetermined overhead rate based on capacity, any under-applied overhead is seen as the cost of idle capacity. So cost of idle capacity is treated as a period expense, not inventoried. Remember, we talked about product costs versus period costs. The cost of idle capacity will be expensed as a period cost rather than inventoried as a product cost. So under this method, any under-applied overhead will be separately disclosed on the income statement as a cost of unused capacity. Keep in mind that such a treatment is not permitted for external financial reporting under IFRS. So this is a pretty much a moot point for us in Canada. Okay, now we're going to take a closer look at the key accounts. First up, for raw materials inventory. Raw materials inventory is an asset. Raw materials inventory is also an asset account. Assets will have balances. So we will have a beginning balance for raw materials inventory. Assets are debits. So the beginning balance for the raw material inventory, you will put on the debit side of the key account. When raw materials are purchased, the raw materials inventory increases. So you will debit raw materials inventory for the purchases. The numbers in the parentheses relate to the journal entries that we looked at a little while earlier. When raw materials are issued in the form of direct materials, we will credit raw materials inventory for the dollar value of the direct materials used. Similarly, when raw materials are issued as indirect materials, we will credit the raw materials inventory for the cost of indirect materials used. You will add up the amounts on the debit side. You will also add up the amounts on the credit side. The total of the debit will be greater than the total on the credit side. Or at worst, the two sides will be equal to each other. If that were the case, there will be no ending balance of raw material inventory. But most cases, there will be some ending balance of raw material inventory left over, and that will be shown on the debit side of the T account. Next up, we'll take a look at work in process inventory. So work in process inventory is also an inventory account. So we'll have a beginning balance. Now, to your work in process inventory, you add the various manufacturing costs. And remember, manufacturing costs are direct materials, direct labor, and manufacturing overhead. And in the job order costing universe, we will actually be debiting work in process inventory with the applied manufacturing overhead. So that's very important to keep in mind. You will debit work in process inventory with the applied manufacturing overhead. As the production is completed, the goods are moved out of work in process inventory into finished goods. So we will credit the work in process inventory for the cost of goods manufactured. Typically, there will be some goods that still remain in work in process. So there will be an ending balance for work in process. Now you will recall that if the manufacturing overhead was over applied, then an adjustment is made to three accounts: work in process, finished goods, and cost of goods sold. So if applicable, there will be a credit to work in process for adjustment for the over-applied manufacturing overhead. This may not always be the case, but wherever the manufacturing overhead is over-applied, there will be a credit to the work in process inventory resulting from that adjustment. So after making that adjustment, we'll get the adjusted ending balance of work in process inventory. For manufacturing overhead, on the debit side, we will record all the actual manufacturing overhead costs. And these include indirect materials, indirect labor, and other actual manufacturing overhead costs, including utilities costs, insurance costs, amortization, all relating to the manufacturing facilities. On the credit side, we'll put the applied manufacturing overhead. Remember, we had debited work in process for the applied manufacturing overhead. The corresponding credit is to manufacturing overhead account. After the year is completed, you will add up the debit side and compare it to the credit. We can have two situations. Either the actual manufacturing overhead is more than the applied manufacturing overhead, in which case we'll have an under-applied manufacturing overhead, or the opposite, the actual manufacturing overhead is less than the applied manufacturing overhead, which means manufacturing overhead was over-applied during the period. Now, either way, manufacturing overhead cannot have a balance remaining. That balance has to be closed out. So if there was an over-applied manufacturing overhead, we will debit manufacturing overhead to clear out the manufacturing overhead account, and credit work in process, finished goods, and cost of goods. If, on the other hand, manufacturing overhead was under-applied, we will credit the manufacturing overhead account and debit cost of goods. So either way, whatever's the balance remaining in the manufacturing overhead account needs to be cleared out. Finished goods inventory, again, being an inventory account, has a beginning balance. The goods that were completed were transferred out of work in process into finished goods. So debit finished goods for the unadjusted cost of goods manufactured. The cost of goods manufactured plus the beginning balance of finished goods gives us the cost of goods available for sale, of which some goods were sold during the year and the balance remain unsold. Again, just like work in process, if applicable, we will adjust for over-applied manufacturing overhead by crediting finished goods inventory, and we will then get the ending adjusted balance for finished goods. Cost of goods sold. Cost of goods sold does not have a beginning or ending balance because it is an item that belongs to the income statement. From the finished goods inventory, we will have transferred out an amount for unadjusted cost of goods sold. Depending on whether manufacturing overhead was over or under applied, there is going to be an adjustment made to cost of goods sold. For under applied cost of manufacturing overhead, the adjustment is made to the debit of cost of goods sold. So an under applied manufacturing overhead results in cost of goods sold increasing. On the other hand, an over applied manufacturing overhead will result in cost of goods sold being decreased. Keep in mind that in the case of over-applied manufacturing overhead, the adjustment is made to work in process, finished goods, and cost of goods sold. Regardless, after the adjustment, we get the adjusted cost of goods sold. Next up, we'll be taking a look at the T account for sales and operating expenses. The T account for sales is the simplest of the lot. All we have to do is show the actual sales dollars on the credit side. Keep in mind, sales is revenue, revenues are credits. So those are fairly easy marks to lose on an exam if we didn't remember that simple fact. If you're asked to make a T account for sales, you have to remember to show the amount on the credit side. Similarly, for the operating expenses, expenses are debits, so you will show the actual selling and administrative costs incurred by the business on the debit side of this operating expenses T account. And then keep in mind, students often forget to do this. You must add them up to give a total. Okay? Once that is done, you'll be ready to prepare the schedule of cost of goods manufactured. Here's a quick reminder. The cost of goods manufactured is about taking total manufacturing costs, which is direct materials, direct labor, and manufacturing overhead. Add to the total manufacturing overhead cost the beginning work in process. Take away the ending work in process. Now, in a job order costing world, you will deduct the adjusted ending work in process, adjusted balance from the T account. And that'll give you the cost of goods manufactured. The detailed preparation, we'll take a look at it now. So there must be a title. You'll start with direct materials, the calculation of which involves taking the beginning raw materials inventory, add to that raw materials purchased to get the cost of raw materials available for use. From this cost of raw materials available for use, you deduct the ending raw materials inventory to get the cost of raw materials used for production. Now, the raw materials that are used for production, they may be classified as direct or indirect. This raw materials used for production is the total of both. If we're interested in calculating just the cost of direct materials, we need to minus the cost of indirect materials to get the cost of direct materials used. Next, we will include direct labor costs. Now, the direct labor costs are sometimes given to us. Sometimes we're given the total cost of wages paid, from which we need to minus the indirect labor cost to get direct labor. Now, why did we take out indirect materials and indirect labor? Because these actually belong under manufacturing overhead, right? If we did not deduct the indirect materials cost from the calculation of direct materials and the indirect labor costs from the calculation of direct labor, then we will end up double counting these numbers. Other manufacturing overhead costs incurred include factory rent, utilities, depreciation, so on and so forth. You'll add all of those up to get total manufacturing overhead. Now, total cost of direct materials plus total cost of direct labor plus total cost of manufacturing overhead gives us total manufacturing costs. To this total manufacturing cost, you will add beginning work in process inventory and subtract the ending work in process inventory, the adjusted amount from the T account to get cost of goods manufactured. This is almost a short question. on your first midterm exam. So you should be paying very close attention, not just to this format, but also do practice questions. Finally, the income statement. The layout of the income statement is we'll start with sales, take away cost of goods sold to get gross margin, take away operating expenses to get operating income, subtract income tax expense to get net income. The detailed layout, you'll start with a title sheet. Sales revenue. Then for cost of goods sold, we have to calculate the cost of goods sold, beginning with the beginning inventory of finished goods, to which we'll add the cost of goods manufactured. Now, this number, make sure, is the same as the one you concluded the schedule of cost of goods manufactured with. Okay, so this has to be a continuity. Beginning inventory, add cost of goods manufactured, gives us cost of goods available for sale. From this cost of goods available for sale, take away ending inventory of finished goods, and we get cost of goods sold. Sales revenue minus cost of goods sold gives us gross margin. From gross margin, we have to subtract operating expenses. Now, operating expenses are selling and marketing expenses or administrative expenses. So the total operating expenses that we get, we will subtract from gross margin to get operating income. Based on operating income, we'll calculate income tax expense. Usually you're given a percentage, 15%, 20%. You calculate the amount, subtract the income tax expense from operating income to get net income. To demonstrate this process, I will be posting a separate video on problem 5-18. It will involve the use of Excel, so that will be a separate video. In class, we will be doing examples from the lesson notes. I have included some very detailed questions that are modeled on old midterm exams. So we will be doing those problems in class to the extent possible. It is vital that you folks practice questions of this nature as much as you can. Make sure you understand the format, you remember the format. Yes, there'll be an exam written from home, so that means it's take home, but you cannot rely on the use of your notes because you'll be bound by time. You'll be running short on time if you were planning on looking up your lesson notes and try to figure out what to do. So it is vital that you prepare ahead of the exam and do some practice. You want to do your practice using Excel because you will be doing your exam on Excel. Excel makes the process easier because it can handle the arithmetic calculations for you. Okay, so on that note, this is the end of the second lesson. It was slightly longer than usual. I hope you do watch this video to the end.